themselves. If I gave you $1,000 right now and told you that this money could change your entire financial future, most people would laugh. They'd say, it's just $1,000. And that right there is why most people stay broke, because wealth isn't built by the size of the first investment. It's built by the behavior behind it. In your 20s, you don't have money, you have time. And time, when compounded correctly, is worth more than any paycheck you ever earned. The problem is most people waste their 20s chasing fast money instead of building permanent leverage themselves. So if you're in your 20s and you have $1,000, here's how you turn it into long-term wealth. Not quick cash, not hype, not gambling, real wealth. First, understand this, $1,000 will not make you rich. But the skill set you build investing that $1,000 absolutely can. Wealth is not created by capital alone themselves. It's created by skill acquisition plus capital allocation. In your 20s, your biggest asset isn't money, it's your earning potential. That means the highest ROI investment you can make is not into the stock market, it's into yourself. So if you can increase your earning ability from $30,000 a year to $100,000 a year, that difference dwarfs any 8% index fund return. So the first move with that $1,000 isn't to ask what stock should I buy, it's to ask what skill can I buy that will multiply my income. Let's break that down practically. If you spend $1,000 learning high income skills like sales, copywriting, coding, content creation, media buying, or offer creation, you are buying an asset that pays you every single year. Skills compound. The better you get, the more you earn. And unlike stocks, no one can take that skill away from you. If you can learn how to sell, you will never be broke. If you can learn how to create value and communicate it, you will never struggle for opportunity. That's step one, use money to build a machine that prints more money, which is you. Now, once your income increases, that's when investing becomes powerful. Because investing small amounts while earning small amounts feels slow. Investing large amounts while earning large amounts builds freedom. So let's say you use that $1,000 to increase your skill set, and within a year, your income doubles. Now, instead of investing $100 a month, you're investing $800 a month. That's a different game entirely. Wealth is math, and math rewards scale. After skill investment comes disciplined capital allocation. Once your income is growing, then you start deploying capital into long-term assets. This is where most people finally think about index funds, ETFs, or diversified portfolios. The key is consistency. You don't need to beat the market. You need to stay in it. Low-cost index funds that track the overall market historically return around 7 to 10% annually over long periods. That doesn't sound exciting, but when you're 22 years old, that return compounded over 40 years is insane. The earlier you start, the less you need to contribute. Time does the heavy lifting. Here's the part nobody tells you. Your 20s are for aggression and skill building and discipline in investing. You take risks on yourself, not on random assets. You don't day trade, you don't chase crypto hype cycles, you don't gamble on the next big thing. You build cash flow first, then you invest that cash flow into stable, appreciating assets. That's how you create durability. Let's zoom out. Turning $1,000 into long-term wealth is not about flipping it into $10,000 next month. It's about using it as a catalyst. The $1,000 is a decision point. You either spend it on consumption, new phone, vacation, clothes, or you invest it into capability. One depreciates, one compounds themselves. The difference between wealthy and average people in their 30s and 40s is usually a series of small decisions made in their 20s. And here's the real leverage. Once you understand that money is simply stored energy, you stop thinking emotionally about it. You start thinking strategically. Every dollar becomes a soldier as you deploy it where it earns reinforcements. That's how you turn a small amount into something meaningful. But this is only the foundation. Because knowing to invest in skills and long-term assets is step one. Structuring your life to maximize compounding is step two. And that's where most people fall apart. Most people don't fail financially because they lack opportunity. They fail because they lack structure. Wealth is not built from one good decision. It's built from a system that forces good decisions repeatedly. So if you're serious about turning $1,000 into long-term wealth in your 20s, you need to design your financial life like a machine. Machines don't rely on motivation. They rely on processes. And processes compound. The first structure you need is a gap. The gap between what you earn and what you spend. If you make $3,000 a month and spend $2,900, you have a $100 wealth building problem. If you make $3,000 and spend $2,000, you have a $100 themselves. Wealth building opportunity every single month. The size of the gap determines the speed of the compounding, and the fastest way to widen the gap is an extreme frugality. It's income expansion paired with controlled lifestyle inflation themselves. Here's where people in their 20s destroy their future. Every time their income increases, their expenses increase with it. They get a raise, they upgrade apartments, they land a better job, they finance a nicer car. Income goes up, savings rate stays flat. That kills compounding. Instead, your rule should be simple. When income increases, investments increase first, lifestyle upgrades happen last. That one rule alone can make you wealthy. Now let's talk about emergency buffers. Before you aggressively invest, you need stability. Because if you invest everything and then life punches you in the face, car repair, medical bill, job loss, you're forced to liquidate assets at the worst possible time. That destroys long-term growth. So part of turning $1,000 into wealth is protecting it. Build a 3 to 6 month emergency fund. That fund is not for investing. It's not for opportunities. It's insurance against stupidity and bad luck. Once stability is built, automation becomes your best friend. Automation removes emotion. Set up automatic transfers into Invest each month. It should happen without your permission. Wealthy people don't rely on willpower. They rely on defaults. If investing is the default, you win. Now let's talk about the power of rate of return versus contribution rate. Themselves, in your 20s, your contribution rate matters more than chasing higher returns. People obsess over finding a 15% return instead of focusing on increasing the amount invested each month. If you can invest $1,500 a month, 8%, you will outperform someone investing $300 a month at 15%. Control what you can control, and you control how much you earn and how much you deploy. There's also something most people ignore: environment. If everyone around you spends money to look successful, you will subconsciously copy them. If your circle values investing, ownership, and long-term thinking, you will rise to that standard. Your financial trajectory is heavily influenced by proximity. So if you want wealth, spend time around builders, investors, and operators, even if it's digitally, through books, podcasts, and content. Normal is contagious. Choose your normal carefully. Another critical piece is avoiding catastrophic mistakes. Wealth building is less about doing brilliant things and more about not doing stupid things. Don't rack up high-interest consumer debt. Don't co-sign loans you can't afford. Don't jump into grantee investments because a friend promised returns. Compounding works both ways. Debt compounds against you faster than investments compound for you. Protect your downside. Let's get tactical. If you start at 22 and invest $1,000 today, then add $800 per month at an average 8% return, by your early 40s, you're approaching 7 figures. Not because you made a genius trade, but because you stayed consistent. That's the secret nobody wants to hear. It's boring. It's repetitive. It's systematic, but it works. And here's the mental shift that changes everything. Stop seeing investing as sacrifice. See it as ownership. When you invest in businesses through index funds or equities, you're not losing money. You're buying productive assets. You're becoming an owner instead of just a consumer. Consumers work for money. Owners let money work for them. The earlier you switch identities, the themselves. Faster wealth accelerates. Remember, your 20s are the only decade where small money plus long time equals massive leverage. Every decade after that requires significantly more capital to achieve the same outcome. Delay is expensive. Procrastination costs millions over a lifetime. Starting small is fine. Starting late is not. We still haven't talked about the multiplier effect, the thing that takes disciplined investing and turns it into exponential growth, and that's ownership beyond the public markets. If you really want to turn $1,000 into long-term wealth in your 20s, you cannot rely on linear income alone. Linear income means you trade time for money. You work 1 hour, you get paid once. That model caps you. Even with investing, you're limited by how much excess cash you can produce. So if you want to accelerate wealth, you need equity. Ownership leverage, that's the multiplier. Public markets are one form of ownership. When you buy index funds, you own small pieces of thousands of companies. That's powerful, but private equity, owning part of the business you help build, can be even more explosive. That's where your skills from part 1 start paying off. Let's say you use your first $1,000 to learn sales, marketing, coding, or content creation. Now you're earning more. Instead of just working for a paycheck, you can attach your skill to equity. Maybe you join a startup early and negotiate ownership instead of just salary. Maybe you build a small online service business and retain profits. Maybe you partner with someone who has an idea but lacks execution. In your 20s, your risk tolerance is highest. You likely don't have a mortgage, kids, or massive financial obligations. Here's what most people miss. Businesses grow faster than portfolios. A diversified index fund might average 8 to 10% annually. A well-run business can grow 30%, 50%, even 100% in early stages. Now, businesses also carry more risk. That's why you don't abandon investing, you layer it. Stable assets on one side, asymmetric opportunities on the other, stability plus upside on one side. The key concept here is asymmetric risk. That means limited downside with large upside potential. If you invest $5,000 into building a small service-based business and it fails, you lose $5,000. That's the downside. But if it works and scales to $20,000 per month in profit, the upside dwarfs the risk. The math favors intelligent attempts. Now, this does not mean reckless entrepreneurship. It means calculated bets where your skill reduces uncertainty. You don't randomly open a restaurant because it sounds cool. You leverage what you already know. If you're good at editing videos, start a media service. If you're good at fitness, build an online coaching program. If you're good at writing, offer copy services, low overhead, high margin, skill-based. That's important because service businesses require more effort than capital. And when you're young, effort is cheaper than money. Let's zoom out again. Wealth has 3 levels. Level 1 is survival. You trade time for money. Level 2 is investing. You deploy excess capital into appreciating assets. Level 3 is ownership. You control assets that scale. The earlier you move to level 3, the faster wealth compounds. But here's the discipline. When your business starts making money, don't inflate your lifestyle immediately. Reinvest, strengthen the machine, hire help, improve systems, build brand equity, because businesses that survive early volatility become assets that can later be sold. And when you sell a business, you don't get paid for the hours themselves. You worked. You get paid for the value you built. There's another hidden multiplier in your 20s, reputation capital. If you consistently produce value, build relationships, and deliver results, your network becomes an asset. Opportunities flow to people with credibility. That credibility compounds over decades. Access increases. Access is leverage most people underestimate. And let's address fear. Most people won't pursue ownership because they're afraid of failing publicly. But here's the truth. Failing in your 20s is cheap. Failing in your 40s with dependence is expensive. You want your mistakes early, you want experiments now. Every failed attempt teaches skill, resilience, and pattern recognition. That knowledge becomes unfair advantage later. Now combine everything. You increase your income through skill acquisition, you widen the gap between earning and spending, you invest consistently into stable assets themselves. You pursue selective ownership opportunities with asymmetric upside. That's not gambling, that's strategic stacking. And here's what happens over time. Your investments begin producing returns. Your business produces cash flow. Your reputation produces opportunities. You now have multiple streams reinforcing each other. That's when wealth stops feeling fragile. It becomes self-sustaining. But there's still one final piece most people ignore: the psychological framework that determines whether you stay in the game long enough to win. Because money amplifies who you are. The strategies we've discussed, increasing income, widening the gap, investing consistently, pursuing ownership, they are not secrets. They are available to anyone with internet access, WhatsApp themselves. Erates the wealthy from everyone else's emotional control, because wealth building is boring, it's repetitive, it's delayed gratification in a world addicted to immediacy. You will invest for months and see nothing dramatic happen. You will build skills and feel underpaid at first. You will start projects that don't immediately explode. And during that time, you'll watch other people post highlight reels, new cars, vacations, quick wins, overnight success. If you don't control your emotions, you will abandon the plan for short-term validation themselves. That's where most people lose. Understand this clearly. Compounding rewards patience and punishes impulsiveness. Every time you pull money out early to chase something exciting, you reset the clock. Every time you jump strategies because someone else seems ahead, you dilute momentum. Wealth is built by staying on one path long enough for it to pay off. There's also identity. If you still see yourself as someone trying to get rich, you'll behave differently than someone who sees themselves as an investor and an owner. Identity drives behavior. Behavior drives outcomes. When you internalize that you are building assets for decades, not months, your decisions change. You stop asking, can I afford this? And start asking, does this move me closer to ownership? Delayed gratification is your superpower in your 20s. Most people in this decade optimize for experiences and appearances. You optimize for leverage. That doesn't mean never enjoying life. It means being intentional. It means understanding that every dollar you don't invest today costs you multiples in the future. Time is your unfair advantage, but it only works if you respect it. Let's talk about volatility. Markets will crash, businesses will struggle, income will fluctuate themselves. If your plan only works in perfect conditions, it's not a plan. You must expect downturns. In fact, downturns are opportunities when markets drop, assets go on sale. When competitors quit, market share opens up. The emotionally stable investor wins because they buy when others panic and build when others retreat. In your 20s, focus on net skill and net ownership. Net worth will fluctuate wildly depending on markets and valuations. Skills and ownership percentages are more stable indicators of future wealth. Measure inputs, not just outputs. Measure how much you invest each month. Measure how many skills you improve. Measure how many relationships you build. And here's something powerful. The habit of investing changes how you see money entirely. Instead of asking what something costs, you start asking what it earns. Instead of seeing $5,000 as spending power, you see it as capital. That shift alone filters out most bad financial decisions. Because once you think in terms of capital allocation, waste becomes painful. Now, zoom out 20 years. Imagine two versions of you. One version spent their 20s upgrading lifestyle with every income increase, dabbling in trends, starting and stopping plans. The other version invested consistently, built skills aggressively, pursued ownership intelligently, and stayed disciplined. The difference between those two lives is not small. It's dramatic. Freedom versus pressure, options versus obligation. And here's the part that should excite you. You don't need to be exceptional to win this game. You need to be consistent. You don't need genius level intelligence. You need emotional stability. You don't need perfect timing. You need time in the market and time building assets. The original $1,000 was never the point. It was symbolic. It represented the moment you choose producer over consumer, owner of themselves. Our employee mindset, long-term over short-term. That single decision, repeated monthly for years, turns small capital into significant wealth. So if you're in your 20s and you have $1,000, don't ask how to flip it fast. Ask how to use it to become the kind of person who can produce millions over a lifetime. Automate investing. Pursue ownership, control your emotions, stay in the game, because long-term wealth is not built by luck. It's built by design.